Right now, 7 companies, the Magnificent 7, make up 37% of the entire S&P 500. Their names are everywhere. If they fall, your retirement account falls with them. And before you say they are too big to fail, investors said the exact same thing about Polaroid back in 1972. It proceeded to collapse by 91%. History repeats itself, but stock market investors are blind to that truth. They never seem to learn from the lessons of the past. Each time they tell themselves the same 4 words. This time is different. Sir John Templeton, one of the greatest investors of all time, called those the most expensive words in the English language. He was absolutely right. Enthusiasm and overconfidence can wipe out a lifetime of gains in just a few weeks. A few investors understood that markets move in cycles. One of them was Jesse Livermore, who made fortunes shorting markets during crashes. He once said, "There's nothing new in Wall Street. There can't be, because speculation is as old as the hills. Whatever happens in the stock market today has happened before and will happen again." In other words, the market is like a theater showing the same tragedy on repeat. The only thing that changes is the cast. The current state of the stock market looks very similar to a forgotten bubble of the past. It is not the dot-com bubble of the 2000s, nor the 2008 financial crisis. It was a bubble that devastated investors when the S&P 500 dropped 50% in less than 2 years, and many of the world's largest companies lost 60 to 80% of their value. It took almost a decade for the market to recover. I am talking about the Nifty 50 bubble of the 1973-1974, a period that Benjamin Graham, Warren Buffett's teacher and mentor, warned about in his famous book, The Intelligent Investor. His warning back then might be more relevant today than ever. Our story begins in the late 1940s. The stock market was forgotten. Nobody cared about stocks. For nearly 50 years, returns were about 2% a year compounded. Stocks were seen as dangerous and unpredictable. The wounds from the 1929 crash and the World War II were still fresh. But that was about to change. From 1975 to 1970, the stock market grew significantly overall, gaining more than 350%. Annual returns in the late 60s exceeded 14%. This long bull run gave birth to a new investing philosophy, simple and seemingly foolproof. Buy big, great companies and hold them forever. It didn't matter what price you paid. Their stock prices only went up. These stocks became known as the Nifty 50, America's biggest and most admired corporations. Coca-Cola, American Express, McDonald's, Polaroid, Xerox, the giants of their time. Investors believed these companies were too powerful to fail. They were the dinosaurs of capitalism. What could possibly go wrong? Spoiler alert, everything. But in investing, when something seems like a sure thing, it almost always ends in disaster. Even the dinosaurs can go extinct. By 1970, Nifty 50 stocks had become extremely overpriced. While the average PE ratio of the S&P 500 was about 18, the Nifty 50 traded far above that. Investors were living in a fairy tale, and Wall Street loved it. Brokers had a nickname for these stocks, one-decision stocks. You only had to make one decision: buy, then hold forever. Coca-Cola was trading at 46 times earnings, Xerox at 49, McDonald's at 86, Polaroid at 90. On average, the Nifty 50 traded around 42 times earnings. For reference, that's like paying $42,000 for a small business that earns you $1,000 per year in profit. At their peak, these 50 stocks made up almost 45% of the entire US market. the dinosaurs ruled the land. Benjamin Graham, Warren Buffett's mentor, saw the cliff ahead. In 1972, he wrote a warning in the Intelligent Investor book. He told investors to prepare for catastrophic collapse. Nobody listened. 16 months later, the market crashed 50%. Why was he so concerned? Because he saw the numbers. The average PE was extremely high, and something even more worrying had occurred. Bonds were yielding 7.5%, while stock dividends were only 3%. Safe, risk-free bonds were offering better returns than risky stocks. Graham knew this imbalance couldn't last. When safe money pays more than risky money, something is fundamentally broken. 65 million years ago, a meteorite wiped out the dinosaurs. In 1973-1974, something similar hit the stock market. A series of shocks struck all at once. Oil prices jumped 400%. Inflation soared to 11%. Unemployment doubled from 4.5% to 9%. And President Nixon ended the gold standard. All these factors hit an irrational market hard, and the problem with the extreme valuations became obvious. The result? Catastrophe. The stock market lost half its value in less than 2 years, the worst crash since the Great Depression. And just like the meteorite, the crash wiped out the dinosaurs first. Coca-Cola fell 60%. McDonald's dropped more than 70%. Polaroid lost over 90%. The so-called one-decision stocks, buy and hold forever, were obliterated. The Nifty 50 era was over. It took 8 years for the market to return to its 1972 levels. Benjamin Graham was right. Mark Twain once said, "History doesn't repeat itself, but it often rhymes." And today the rhyme is clear. Do you see the similarities between that market and today's? Back in 1972, the Nifty 50 made up almost 50% of the stock market. The average PE ratio was 18 and bonds yielded 7.5%, much higher than the 3% dividend yield on stocks. Today, just 7 tech giants, Microsoft, Apple, Google, Amazon, Meta, Tesla, and Nvidia make up about 37% of the S&P 500. They are the new Nifty 50, the Magnificent Seven, as investors like to call them. 7 companies now dominate the entire market. Like the giants of the 1970s, they are seen as too big to fail. Investors believe there's only one decision to make: buy and hold. Price does not matter, as these stocks only go up. But as history shows, that belief never ends well. So what happens today? Do investors repeat the same mistakes of the past? Let's look at the numbers. Google trades at 18 times earnings, Meta at 28 times earnings, Amazon at 35 times earnings, Apple and Microsoft at 38 times earnings each, Nvidia at 53 times earnings, and Tesla at an incredible 290 times earnings. At that valuation, Tesla isn't priced like a car company. It is priced as Elon Musk is about to invent teleportation by next Tuesday. The S&P 500's 3-year average PE is about 24.5, far above 1972 levels. The dividend yield is just 1.2%, and bond yields exceed 4%. Again, safe money pays more than risky money. Sound familiar? It should. We are basically watching a rerun, except this time it's in 4K. The Magnificent Seven are great companies, strong, innovative, profitable. But investors are repeating the same mistake of the past. They have pushed valuations into dangerous territory, driven by emotion and overconfidence. And it is not just the Magnificent Seven. When the giants get expensive, the whole market follows. The fever spreads. Now everything is overpriced. All it takes is a single meteorite. a sudden macroeconomic shock, and the new dinosaurs could fail, just like before. Because, as Warren Buffett once said, what we learn from history is that people don't learn from history. If Benjamin Graham was alive today, he would give the same warning he gave in 1972. The investor's chief problem and even his worst enemy is likely to be himself. History has already shown us the pattern. The warnings are here. The outcome is predictable. But don't worry, this time is different.